So happy to see you guys in here tonight. And tonight I get the privilege of introducing someone who truly understands what it means to build not just wealth, but impact. Gio Paradis he's an operator, an investor, and a leader who doesn't just talk strategy, he executes it. He has built businesses, scaled teams, helped countless investors, and that think bigger than what's possible in this market. What I respect most about Gio is his work ethic. He is unparalleled in his work ethic. He also brings a lot of clarity. He simplifies complex moves, challenges limiting beliefs, and he shows you how to position yourself for long-term growth, not just quick wins. If you are serious about leveling up tonight and learning all this creative financing, definitely lean into what he has to say tonight. And I am so happy to introduce my friend and partner, Gio Paradis.
What an introduction. I'm mic'd up. How's everybody doing this evening? Thank you guys for coming out. Who's ready to make some money? There we go. I like it. I love the energy. Can y'all do me one quick favor and download, if you do not have this on your phone, go to the App Store, download a mortgage calculator. You're going to need it tonight. You're going to need it for this training, a mortgage calculator. It's free. So anyone go download one. They got all different kinds of mortgage calculators, but in order to help you guys really structure these deals in person and live, we're going to need that mortgage calculator. Thank you again, Carrie, for the introduction. I entered this space about 3.5 years ago. I moved back to my hometown of Virginia Beach, Virginia, partnered with my partner and started the Camus Group. For those who haven't heard of us, we're a real estate investment company. We started off as a wholesale operation and quickly expanded into an acquisition company. Now have transitioned into the commercial space. I bought my first property here January of 2023. And since then, I have over 56 properties and I have about $8 million pending in escrow to close, commercial, all creative financing except one. So I bought all of my properties and acquired all of them through creative financing. It has been an amazing tool for me, and I'm very excited to share that with you guys. Why do you guys, I'm going to start this off with a little bit of questions. Let's start off with someone who has scaled a portfolio. I know we have some heavy hitters in here, but what was your biggest challenge in scaling your portfolio? Because creative finance is something relatively newer in our space, I guess, last decade. It's something that's newer, but people that have been in this space for 10, 20 years, if someone would please share, because again, I was a kid back then. There we go, Carrie.
All right, I have been in this space for a hot minute, but I didn't really understand creative financing at all. And if I had, when we went through that meltdown in 2010, I wouldn't be standing here right now. I'd be somewhere in Costa Rica because I would have bought everything. So I think my biggest challenge was learning how to raise enough capital, right, to go buy that property or buy it with cash and then have to refinance it out. So it was always a capital issue when it came to buying properties. And then you were capped out at 10 mortgages. So you couldn't even buy more than 10 until you went into the commercial space. So it was, those were the challenges I ran into, was developing enough capital and figuring out how to scale.
Beautiful. So you guys see the inherent challenge, right, is capital. It takes a lot of capital. And we talk about historical contexts is what happened 08, 09, that crash, right? People were getting no-doc loans, all kinds of stated income, right? It caused that collapse and bubble. I was in high school then, guys, but again, you guys got to study, yeah, it's okay, love you. But you guys got to study history, right? Because history can repeat itself. And so we know a lot today when people think buying an investment property, you got to put 20% down. That's a lot of money, right? Your average home price in Virginia Beach is almost $300,000 now. Even a small townhouse will cost you $250,000, right? So that's $50,000 typically you'd have to put down. That's a lot of money. You must be making a lot of money if you can scale a portfolio and put $50,000 down every time. And then not counting if you got to do renovations, you got property maintenance and stuff like that, right? So again, it's a big cash up. So we're going to talk about how to leverage this. So let's get into slide number 1. Okay, subject 2. I'm going to read this, and we're going to do questions after I read this. This is a lot to digest for people that don't have a base on this. What is subject to real estate? Subject to, got me. That's all right. Subject to real estate refers to purchasing a property while leaving the existing mortgage in place. In this arrangement, the buyer acquires the property title and agrees to make payments on the seller's existing loan without formally assuming the mortgage. The loan remains in the seller's name, but the buyer gains control of the property and is responsible for the mortgage payments. These are some reasons why someone would do a subject to agreement. Why would a seller enter this agreement with you guys? Number one, and then this is customer facing. This is an internal document. I use it at my company. I share it with you guys. It's okay. If you guys take pictures and copy it, I do not care. Number one, you're struggling to keep up with mortgage payments. Rather than falling behind, damaging your credit, you could transfer ownership to someone who takes over the payments without needing to qualify for a new loan. So that's number one, right? Of the power of creative financing. You don't need to qualify. Anyone that's is in this business, we got a lot of agents in here. I see you guys got minimum FICO requirements, DTI, debt to income requirements in order to qualify for a traditional mortgage. With creative financing, you don't need any of that. That is a beautiful thing. Number two, you don't have time or money to fix the home. Subject to purchases often happen as is. No costly repairs, no upgrades, no inspections that derail your timeline. Most subject to properties, and again, I got what I consider in at a lucky time. You know, I didn't get in 10 years ago. If you got in this wholesaling creative space 10 years ago, you really ate, because I missed the COVID wave, right? But I caught that tail end. If you guys look at historical context, what happened in 2022? Anybody know? Someone just said it. Rates, they shot up, right? But during COVID, we had 2.5% to 3.5% interest rates. So we had a lot of properties in our area sitting at a debt service of around an average of 3%, right? That is the whole key and power of subject to. You're buying the rate. I want everyone to understand and write that down. You are buying the rate, you're buying cash flow. A lot of times a seller is going to enter this type of agreement because they have no equity. How are you going to convince someone to take over their loan that's in good standing and they have $100,000 in equity? It's just probably not going to work, right? There has to be some type of pressure point. Usually they're upside down, unable to liquidate a property on the traditional market with an agent. There's two things, right? The numbers don't work. What is another reason why the property might not be able to be listed by an agent? Pre-foreclosure, okay, they're in the arrears or they're behind on payments. Again, that's the math. But condition, right? When you have FHA, VA, which a lot of these properties and these price points that we're buying subject to, they're not going to pass traditional financing. There's too much repairs that, again, mess up the math equation. They might have 50 or 60 grand in equity, right? Real estate fees and commissions are 20, 30 grand, and then they need 15, 20 grand in repairs. You're operating on razor thin margins. And sometimes life happens. We live in a highly concentrated military area. People are transferring next month. They can't afford 2 mortgages on a military income, right? There's all different factors that go in. Number 3, you want to avoid foreclosure, but you feel stuck. This solution can stop the foreclosure process and preserve your credit score, giving you the freedom to rebuild without long-term damage of a foreclosure on your record. Anybody know how long it takes after a foreclosure for someone to buy? 2, 7. From my experience, it's 7. Some of the OGs can help me out here that have dealt with this, but it's 7 years. And a short sale, where's the attorneys at? Help me out on a short sale.
So you mean as far as what?
When they can rebuy a property.
Yeah, again, I actually don't know that. That's a lender question.
Well, foreclosure, but short sale is usually after a year.
Is it 2 years?
2 years? 2 years. 2 years, okay.
So 2 years for a
Gary.
short sale. It's 7 years that a foreclosure will ultimately drop off your credit, right? And that's, yeah.
And then the reason I want to explain this to you, right, to avoid foreclosure. How many people have bought a pre-foreclosure? Raise your hands. It's great. We got some experience in here. What happens with sometimes when you're trying to rush a payoff in, it is hard to stop a foreclosure. When I just bought one in 4 days, it was luck. Usually you don't win on those. But sometimes it's quicker to reinstate the loan. Reinstate the loan means there's arrears, meaning if I have a mortgage payment I haven't paid in 5 months, that means I'm 5 months behind, then the foreclosing attorney is going to levy fees and made up penalties, and you're going to have a reinstatement quote. It's a lot of times subject to is powerful to take control of a property and to save that seller from foreclosure is you reinstate the loan with a subject to strategy and then liquidate the property. The challenge there becomes access, right? Most of investors in this room, you love the property to be delivered vacant. Sometimes with this strategy, you gotta trust people. Good luck. Number 4, you owe more than the home is worth or have little equity. We talked about this. Traditional sales don't always work when you're upside down. With subject to, we work with the numbers to find a win-win solution, even in tough situations. How does it work in a subject to transaction? Number 1, the buyer takes over the property's title. 2, the existing mortgage stays in the seller's name. It is imperative that when you guys pitch and sit down sellers, that you are well educated before having someone enter this agreement. You need to clearly explain this property is going to continue to appear on your credit, it is going to continue to appear on your DTI, and it may impede, if you have plans to buy a home in the near future, it is going to impede that process. Because if you do not disclose that, and it's in your contract, we got 2 great lawyers, John and Austin, right here. We got 2 great lawyers, guys. And I work directly, Austin does so much for us at Thompson Law Group. Shout out to Austin right there. Thank you very much. We got my oceanfront buddy right here, John. So talk to these guys. It is imperative you have proper paperwork. I see a lot of people fail when they get into this game because you guys chat GBT contracts. That's the easiest way to get sued, guys, or the easiest way to lose a deal. Unfortunately, this is a snaky business. There's a lot of snakes, and if you don't have correct paperwork, it's hard to protect yourself. This is not something to take a shortcut on. Go spend a couple $100, $1,000, $2,000, whatever it takes to have ironclad paperwork that is easy, simple, concise for the customer and for you to understand what they're getting into. And again, I highly recommend, and I made this pivot in my business, that to close these deals with an attorney. Just full disclosure, my business partner that owns Half Game, he owns part of Fortis Title and Escrow, and we close with another title company when we do these transactions because it is very imperative to have a legal hand in the deal to make sure all parties understand what they're getting into. So again, disclosures, again, being educated on this process is very important before pitching this. And I tell people so much about the sales process. Anybody in here in sales? Anybody been in a career in sales? Anybody in sales? Everyone should raise their hand. You guys are in real estate. Everyone's in sales. I'm messing with you. So when you're pitching this, I always preach education closes the deal, right? There's 2 reasons why people don't buy. And just to let you guys know, I'm a career salesman, sold cars, sold timeshare, sold real estate, retired real estate agent, boom, became an investor. People don't buy because they don't trust you, meaning they don't trust you know what you're talking about, or 2, they don't understand the product and or service that you're offering. So being super educated, reading books, watching videos, networking with investors that have done deals like this is going to get you the deal. Because that's all you're doing in the process. You're educating them. Once you make the numbers work, which we're going to get into, you're educating them on the process. Slide 2, please.
And let me jump in for 2 seconds, Gio.
Yep.
So again, I'm going to reemphasize this, something he just said. He said it very, very well, but let me hammer home the point. You must make sure that you're doing these things right to the seller, not just absolutely to protect yourself. And you have to have good documentation, but the seller is also putting themselves in a vulnerable position for you. And it can be a good thing. These are very powerful deals. It can be a very good thing for you, and it can be actually a very good solution for them. But I cannot tell you how many, there's another saying, they're called subject sue deals. Because as Gio was saying, there are people who are snakes out there who do not disclose, who try to pull the wool over sellers' eyes. They don't let them know what they're doing or how they're doing it, and then eventually you're going to get sued, and you're going to get sued big on that. I'm just predicting that now. So please, not only to protect yourself, which you have to protect yourself. That's why you got lawyers to help you with your documentation, but also consider, we at Trig are adamant that we want to do things the right way, right? We want to do things the right way, and we want to serve the people that we're helping, even if they're on the other side of the deal. So please make sure you're considering the seller too, and that.
Yeah, absolutely. That was a great point. And again, this is a little pro tip. And I've learned this the hard way. right? Undefeated in the courtroom. Anybody that's been sued knows it's not worth the time, effort, and energy. When you have a lawyer like these gentlemen prepare your contract, when you get to any type of dispute or discrepancy, when you send it over to him, that bill's a lot cheaper because they did your contract. They're familiar with it, and it's a very streamlined process. If I went and send this, John, hey, go look at this, and it's not his paperwork, he's not familiar with our process, that bill is going to go up because his time is going to be more invested in trying to deconstruct the contract, right? Next slide, please. Oh, this is number 2? What was number 1? I thought I just read this, didn't I? No, go back. Go back one more. Oh, number 2, my bad. They just have 4 and 4, my bad. All right, so right here, I guess I copied the same page twice, guys. So now I got to go off script. That's okay. Look, so the second page of this presentation, and I'll get it to you guys, is about the dangers. So I have the dangers. I have this is why you shouldn't do a subject to. And I show the customer this. Due on sale clause. Everyone ever heard that word? Ooh, it's like a scary word. So basically, when you buy a property, one that has traditional mortgage, once you transfer title or ownership, it triggers legally a due on sale clause where they can call the note. So if you owe $300,000, they can call it and you have to pay off that property. It's very risky business. You need to know what due on sale clause is. You need to educate the consumer on this, and you need to disclose this and fully explain to them that you are not assuming the loan. An assumption is different than a subject to. If anybody who has assumed a property, you still have to qualify and go through a bank's process in order to assume that loan. They are not the same thing. So that is some of the risk and considerations. So since I don't have that slide, we can skip to, and again, I thought I had a whiteboard up here. It's my fault for not being prepared. So we can go to it's the 6th slide or 7th slide. We're going to skip over owner financing and novation really quick. Okay, boom. So now I got to deconstruct this. Goodness gracious. All right. So this is a real deal I dealt. So if people have pen and paper, because I don't have pen and paper, you're going to have to do some writing. So what is this? Oh, this is a clicker? No, I don't. Oh, it's a pointer. Okay. What's the button?
That's the bottom.
Okay, thank you. Perfect. Okay. So this is, I'm not going to deconstruct this HUD, but basically we bought this property for about $235, right? The seller owed about $215 on this property. This is the address right here in Portsmouth. I did this deal with a good business partner of mine, Julian Rivera. Shout out, Julian. We do a lot of these deals. The seller owed way more money than they thought. I think anyone that has done any type of volume of deal, you go to closing when people are in distress and they have all kinds of liens on the property. They thought they're walking away with 60, 70 grand and they owe the tax man, they owe all kinds of people, right? So this deal, we were going to do a cash purchase, but things changed and we had to do a subject to. So I'm going to deconstruct this deal the best way I can because I should have had a whiteboard. So this property, if someone wants to Google it, I'm going to get the specs on the house. 5513 Greenfield. And I just sold this property today. This is the purchase HUD. So this property is a 3-bedroom. If you guys want to write this down, write the address. It's 3-bedroom, 2-bath. Just call it 1,400 square feet. This property needed $40,000 in renovations when we walked it. So originally we were under contract to purchase at $215. So this is going to be using, so write $215 purchase price. They owed $200,000, excuse me. Now I'm remembering the deal now. And then we had to bring $15,000 to the table. So I want you to write $215 minus $15,000. Because the $200,000 was the seller's payoff. So when you're buying subject to, it's whatever they owe, your purchase price minus whatever they owe is the cash you need to close. So if I'm buying the house for $350 and the seller owes $300, how much cash am I bringing to the table? $50. Okay, very linear, very simple. So the reason why we structured this deal this way, and I want everyone to understand, anyone that has bought and flipped a home with hard money, they got to pay points. and you pay high interest. This was a 3% interest rate, right? Typical 12 to 14% is what people are lending in the hard money space, and they're typically charging 2 points. So the power of subject to, this is subject to as a flip, guys.
Real quick, explain what a point is, and just in case anyone doesn't get it.
Absolutely. So a point is 1% of the purchase price. So if I'm buying a property for $215,000, I'm going to be paying $2,115 or $50 for
Per point.
Yep, per point. So let's just do it simpler math. If I'm buying a property for $200,000, I'm paying 1 point. That's $2,000. If I'm paying 2 points in fees, I'm paying $4,000 for that hard money, for access to that money. Trust me, it's worth it. Paying 2 points. Some lenders charge 3 and 4 points. So it's all based on the loan amount. 1 point is 1% of the money that you're borrowing. So with subject to, you don't have any of these fees. You don't need to qualify. You don't need to wait for all hard money lenders have their different process. Some need a hard appraisal, some do desk appraisal. You know, they need certain LTV, loan to value, loan to cost, as our lenders talked about earlier. Again, look this stuff up, loan to value, loan to cost. So when we look at this deal, again, purchase price is $215,000. I'm going to make it just really simple to make the math. They owe $200,000. Seller walked away with $15,000. So we go to closing. We're bringing $15,000 plus closing costs. So we bought about $20,000 to close out the deal, right? The difference in that, right, is if I were to go buy from a hard money lender, 2 points, that's $4,000, right? On top of what I would have had to bring. That's $4,000 automatically out of my margin. And then monthly, I'm going to be paying over $2,000, almost $3,000 a month to carry that. So if it takes me 3 months to flip it, that's another $9,000 out of my pocket. With subject to, the mortgage was $1,200 a month. So you see that cut my costs in a third. This is subject to the flip. So we bought the property subject to. We bought it in 2 weeks. We did not have to qualify, right? Why do you think we flipped it and we didn't keep it? Because it had a 3% interest rate. Anybody want to guess? Boom, right? Seller was moving out of state, had a place for a year, and they wanted to buy after that. They were moving out of town. Boom. They wanted to rent. They had a rental for a year, and they were planning to buy the second year. So what do we do, guys? Have an idea? How do you structure the deal to protect the seller? Why would the seller agree to this? What do we have to put on this? Okay, we put money in the seller's pocket. That was one, right? But what do we have to put contractually? And this is, again, why you work with lawyers. Starts with a B. Who said that? Boom, balloon. Yes, sir. So we had to put a 6-month balloon. Balloon payment is meaning the whole loan becomes due. So in 6 months, we have to pay off that seller's primary mortgage. When you're buying a property subject to, again, we're coming to the table, we're bringing the $15,000 that goes to the seller's pocket. The difference between $215,000 and $200,000. We're bringing the closing cost, and the paperwork is a 6-month balloon payment. So that means in 6 months, we have to pay off the seller's original mortgage, because a bank holds, and this is a key, when I go like this is a key word, deed of trust. You're going to need to know this for owner financing. Deed of trust. So that lender is going to have a deed of trust on the property, and that's what we're paying off in 6 months, because we are transferring title. Go ahead. Yes, sir.
Yeah, I'm going to jump in 2 seconds. Deed of trust, right? So you've got a promissory note. Everyone knows what a note is, right? I'm presuming everyone's gotten a loan at some level, but you got the promissory note, you have the deed of trust. Those are the two primary documents that securitize a loan against the property. The deed of trust is the thing that's recorded on the public record that puts the world on notice that a lender has lent you money to buy the property, okay? And it also, I won't get in the weeds, but it also gives whoever the lender is the right to foreclose if you don't pay, right? And we won't get into the legality, but deed of trust is on the public record. It's part of the loan. It's also where that due on sale clause, the transfer title clause is, right? That is important because it is public record, and it's how lenders secure in the public records their loan on property.
Perfect. And also, we're going to continue to go into that with owner financing.
A deed in lieu?
That's a different structure.
No, a deed in lieu is actually like the deed that transfers title. So.
No, they just couldn't pay, and they couldn't. It was tired landlord. They let family members live in the property. They were getting ready to move out, and they weren't going to have eyes on the property. The property was murdered. You know what I mean? It was completely messed up, and so they just wanted to get out from under it, and that's why we were able to do this deal. The cash deal, again, they wanted to close very quick, and I didn't want to offer them what they wanted, cash. So I said if they did subject to, I would do it. You know, it was only, again, like a $5,000 difference. But anybody who's flipped before understands the power of using this to flip a house. And so I use subject to flip as a leverage. I say, look, I'll give you 215. You know, 50. You'll walk away at 50, or I'll do 207 cash. What $8,000? I know for some people we say, oh, it's eight. That's life-changing money for some people. It may move the needle for them, so we never know. Does that answer the question? Yes, ma'am. Yeah, perfect. So again, as Mr. Bowen said, they didn't want to keep the loan open. So if they don't want to keep the loan open, you have to put something in legally. Like if I just say, hey, I'm going to pay your mortgage off in 6 months, we're good, right? You know, you have to, again, this is why you work with lawyers, and you put in a structure where, hey, in 6 months, no matter what, because that property can sit on the market, guys, right? And what that seller's counting you to pay that property off, that note gets called a balloon. The balloon means it blows up, I guess, is why they call it a balloon. It blows up and becomes due. It goes from being a small payment, and then boom, it's one big payment you need to pay the property off. Does that help you? Yes, because there's going to be an original mortgage. You're going to have an original mortgage on the property. That's what we're taking over. When you're taking over a property, you're taking over their original mortgage that the seller got in their name, whether it's a VA, FHA, or conventional loan.
So just to clarify too, what Gio's talking about is the balloon was negotiated with the seller. It's not an actual function of the original loan. Right, the original loan would still go on and be a 30-year mortgage per se, but the part of the deal and the contract that he had with the seller is, hey, there's going to be a balloon payment I'm going to make sure your loan is paid off by 6 months. So that's what he means by a balloon payment. Is that right?
Yep, perfect.
Okay.
Yep. Yeah, you're adding a legal structure to the contract. It protects the seller. But again, knowing how to structure this and explain this to them and articulate, hey, I'm going to put a balloon payment on your property, because it negates the biggest objective to a subject to. When you're pitching this in the property, the biggest objection you're getting is like, I don't want my loan open for another 22 years, Mr. Giovanni. Are you crazy? Right? So again, this is how you alleviate, and you got to try to find the middle ground, right? Again, there has to be massive amounts of equity in order to do this structure, because you got to have some way to exit it out. So again, flipping, this is, I guess, the most untraditional way to exit a subject to. When you guys see most of these deals pitched out, they're pitched as rentals, right? And so I'm giving you, and we're going to get ready to get into that. There was one more question.
They weren't behind in their mortgage payments. You're saying that there's equity there. How do you go about finding something in order to use this strategy?
I mean, everything's motivation, right? Motivation dictates the pace of a deal, the structure of a deal. So in this case, again, my friend and partner Julian, he called me up and said, look, these people need to move fast. This is what they need to walk away with. This is what they need to do. No one's paying that price cash. What can we do? How can we get them the money, right? Doing these structures allowed me to take market share when I came in. Doing this because I was offering everybody way more money than my competition. I'm offering sellers $5,000, $10,000, $15,000 more than the next highest bidder. Yes, sir. Yes, sir.
Hey, thank you. Name's Charles. I understand you paid the $215 for the property.
Yep.
I understand the balloon payment at the end. I understand the person walking away to $15,000. I'm trying to understand the net. What was the upside for you as an investor? Okay,
Yeah.
So you say the house was
I'm
going
pulling it
down.
up.
You said the house was going, so I'm trying to figure out what was the ARV after the money
Perfect.
invested. What made it
Yep.
attractive to you?
Yep.
Go back to
Yeah. Yep. You're right. Well, no, this is the purchase HUD. So it might be the purchase or the sale HUD. I sold this property for $350. Yep. There it goes.
Okay.
So I bought it for $215. I put 40 into it, and I sold it for $350. So we made like $70,000 on the flip.
Enough margins left.
Yeah. So again, it had enough margin where if I wanted to keep it as a rental, which we'll get into in a second, I could have kept it as a rental. But when I have these fat of deals, I sell them. And again, I'm transitioning out of residential. Anyone scaling a residential portfolio, it's a headache. And the tax advantages aren't as good as commercial. So flipping properties, anyone that flips, all we do is get taxed. The only way to combat that is to have tax shelters. Yes, ma'am.
What would happen? I assume you don't have 200 some grand just
Excuse
to.
me. If we have a question, just hang on 1 second. We'll bring you a
sorry.
microphone.
Yeah,
That way everybody can hear you.
So in 6 months, if you had not been able to flip that, how would you have come up with the money to pay off the mortgage? Would you get a hard money lender? How would you fix that?
Perfect. So yeah, that's an excellent question. Do we have any lenders in the building? I thought someone just we have Sean Bowen, Full Circle. Do we have any long-term lenders in the building? Gentleman back here. What was the name of his company? Someone have
Private money man.
Oh, private money. Oh, that even better.
Private money man.
That's your best friend right there. So you got Mr. Bowen, you got this guy with private money, this gentleman right here, and then you have, Ability DSC. Again, look, in the beginning, I got lucky. I partnered with someone that was financially solvent, bankable, as my man Mark Frisco would use. I copy that term. Now I don't have to worry about it now because I'm very bankable, so I can easily just go refinance the property. But again, you got to know the math. Everyone knows you make money when you buy. So again, I sold the property for $350. So if you guys want to just pull out your simple calculator, a usual DSCR lender is going to loan up to 80% of that value. So you do $350,000 times 0.8, and that's $280, right? That's as much as I can pull out of that property. And again, it's based on not really my credit worth. You need a minimum FICO of like 620, depending what DSCR lender you need. So DSCR is a powerful tool, what I use as a backup plan on these. So obviously if I bought it for $215, I put 40 into it. I'm only in it for about $260 to $265 of closing costs and holding costs, and I could refinance up to $280. So I know right then and there, day one, if I got in trouble, boom. And is it a gamble? Yes. This is, oh yeah, of course. If you don't have a plan, you have a plan to fail.
Yeah.
You know what I mean? Yes, I don't go, yeah, everything's gonna go great. Everyone knows in real estate, nothing goes as planned, right? Yeah. So with that, I have the DSCR in place. Again, people like Sean, people like this gentleman here, that if you come into a bind, you go to them, it's gonna cost you some money, but you gotta understand the service they're providing. They're protecting the $40,000 in renovations I put in the property. They're gonna go, boom, take them out. I'm gonna have to lose a lot of my margin, but it's better than losing $40,000.
Yep.
So it's great to know them, again, this is something I stress in this business. Have all these people in place. That's why you guys are in this room before you start doing the deal. Because when you're in trouble, you're calling for help. That's like, you're trying to call the fire department, you don't know the number. You got to already have these relationships, and it's very important to do that.
Yeah, really quickly to chime in. He just said it. Make sure you have a backup. And my mentor in real estate always, you got to have a backup of the backup, right? You need to know if you get in trouble, if the lender were to call the note, or if something else were to happen. What's your backup plan, right? Not only to protect yourself in the investment, but also to protect that seller, right? Because if you don't pay the mortgage as you hold it, their credit just gets destroyed, right? And I've seen lawsuits over that, right? I've had to deal with lawsuits over that. So know that. Also, really quickly, Gio keeps talking about DSCR loans. You probably heard the lenders talk about that. I'm just going to say DSCR is debt service coverage ratio. Go talk to any of the lenders in the room about that. We won't spend too much time on that right now, but it's a really great loan product for investors to be able to have backups for lenders that you don't have to go through the normal extensive process.
Perfect. Love it. That was great. So we're going to talk about this as a rental now, guys. We're going to take the same example. The seller wants to walk away with $15,000, and they're allowing us to keep the property forever. I say forever, but until term. So let's say there's 27 years left on the mortgage for this example. The payment, PITI, if you guys want to write that down, that's the most important thing. If you're trying to structure these subject to deals, you need a mortgage statement. You know what your pity payment is. Principal, interest, taxes, and insurance. And you have to make sure they're current. There's no arrearage, right? Because if you have arrearage, you got to factor this into this equation. Now, for me, every investor has their different metrics that they like, that they really enjoy. My only metric I look at, and I know this sounds crazy, but it's cash on cash return. When it's single family, that's all I care about. When I put the money out, when is it coming back home? If anyone watches Shark Tank, I love Kevin O'Leary and what he says. When it coming back home to Papa, right? The dollars. He puts hard hats on his dollars. So again, we're buying it for $200,000. $215. We gave $15K in cash. So I want you guys, if you want, put two columns on the right side of that little column. You're gonna write 15,000. You're gonna put plus and put cash to seller next to it. So 15,000 cash to seller. Then you're gonna, I'll do it like this. I'll draw it. Then you'll put 5,000 cash or closing costs. And then for this example, put 25,000 renovations. The reason why I dropped my renovation from 25,000 down from 40,000, because when I flip a home, this is my model. Everyone has different models. I make sure everything is spick and span. The crawl space, everything encapsulated, your every major system. Because look, you're not going to hide from a home inspector, especially the one these days, man. They're crazy. I got licensed over 10 years ago, and in this area, and they weren't the way they are now. They're kind of crazy now. So with a rental property, you don't have to go in high-end finishes. You don't got to put quartz. You don't got to put granite in. You don't got to put top-end appliances. You can recycle, refurbish appliances from your other properties. When I buy a flip, it may have good appliances, but not good for a flip. I can keep it and put it in a rental property, right? So you're going to save some money by turning this into a rental. So we got 15,000 plus 5,000 plus 25,000. So that is 45,000, if I'm doing the math in my head correct. So that is cash in the deal. So when you sum that up, right next to it, cash in the deal, you got 45,000. Our PITI payment for this example is $1,200. So that means all in $1,200. That's what you're paying a month to take over the mortgage. The property, once it's renovated, it is going to rent out for $2,100. So what you need to do is get what is your monthly gross. It's going to be gross, but gross cash flow. So $2,100, that's your rent minus your mortgage of $1,200, $900, right? That's what you're making a month. When you do all these equations, I want you to annualize it or times it by 12. So now we're going to annualize that monthly income. So we make $900 times it by 12. So, 10,800. That is bright. So I want you to do 10,800 divided by 45,000. So that's NOI, even though it's not your true net. I mean, everything in the property is completely renovated, but this is how I run it really quick on a napkin. If you guys really want to dive down deep into it, we can talk about that offline. I'm trying to power through this because we're running behind. So 10,800 is your NOI, divide by 45,000 cash in the deal, equals, somebody get me that percentage. 24%. Love it. So that hits right where I want to be. I want to be over 20. I'd love to be 25 and up. And this is a better neighborhood in Portsmouth. I, again, look at what we're going to be at. So we can reverse engineer this deal. I'm in it for 215, right? Plus 5,000, that's 220. Plus 25,000, right? That's 245 all in, right? That's what my basis is. ARV is what? 350, right? So what is 245 divided by 350? Someone do that for me. So what you owe versus appraised value. I'm sorry? 70%. So you're at 70% loan to value. I love that number as well. Why does that matter? Why do people think what loan to value in the property matters if we're keeping a sub 2 long term? We just talked about it. Who just said it? Refinance. Yep. So we talked about what happens when they call the note. Well, if I'm in the property at 70%, because it's a long-term sub 2, who knows what happens, right? I know that I'm in really good shape to quickly refinance that property, or I got enough meat on the bone to call my private money guys if I have to cash it out in a fire sale type of event. Yes, I'm going to lose probably 10 grand to 15 grand of equity because I'm going to have to have them come in, close on it, then I'm going to have to go take the time to refinance it, right? Again, this is the importance of having a great legal team when you do these deals.
And remember, backup with a backup. Backup with a backup. Have the plan, as Gio's saying.
Yeah, absolutely. So again, I know this is a very quick crash course on this, but you guys see how I run my numbers when you're evaluating, should I buy this a rental? Now, if I were to buy it as a traditional rental, $215,000, I'm going to have to put over $40,000 down. If I'm buying it as a regular, conventional, non-owner occupant loan, right? That's 40 grand plus 25 grand in renovations. That's 65 plus. I'm in the property way more. Someone want to do that cash on cash return? Someone do 10,800. That's your NOI on this property divided by 70,000. That's what it would take you the traditional way. So 10,800, your NOI divided by 70,000. 15? Yeah. So you guys see, how much difference in a cash on cash return, how quickly your money is going to come back home. Because the quicker that money comes back home, you can redeploy that capital and scale, buy more, because you're just trying to buy cash flow. With this deal, it would have been great to keep because we had a lot of equity, right? But a lot of these deals have little to no equity, and that is a risk. So you have to really understand what you're doing. There is one thing, if you guys want subject to deals, I'm going to give you one quick tip how to get a subject to deal in the next 30 days. There's one thing you need to identify on the house, and there's a good chance it's going to be a subject to deal. Has someone got a good guess of what it is? There's one thing you can walk outside, you're walking down the neighborhood, and you see on the house, oh, that's a subject to deal. Notice that doesn't mean it's a good subject to deal. Tall grass? Nope. Handicap ramp. These are all good guesses, but no. Yep. Nope. These are distressed properties, which is great. But how do you spot a subject to just walking down the street? Solar panels. Solar panels. I own probably 20 houses with solar panels. I hate them. They're the biggest scam out there. Guys, sorry, Ion Solar, if I have any solar guys in here. But, I mean, that business is fading, by the way. They've been deregulated. But solar panels, they don't fully understand these agreements they get in. What happens is a property, let's say it has $100,000 in equity, right? Well, they got 30, 40 grand in real estate fees, and then they don't understand that solar panel is leaned against the property. It's another 30 or 40 grand. So you got 20 grand left to work with. You don't got much, And so understand that a lot of these deals, you can assume the solar, right? And again, one thing, I tried to do this, guys, and I failed. Just to let you know, I didn't lose money, but in my opinion, I lost money because I made like $10,000 on the flip. But I paid off the primary loan and assumed the solar, then the solar went to first position. Yeah, it got me. They got me. I thought I was smarter than them. Yeah, I had to pay off the solar when I flipped the house. But solar panels, guys, look for those deals, people that have them, because a lot of times when they go to resell those properties, it wipes out whatever equity they've built, unfortunately. And they don't fully understand that. So it's a little quick trip. Yes, ma'am.
I'm walking down the street.
Yep.
I see the house that has the solar panels. Essentially, if it has a slim, it could be a situation where there's slim equity. Is that a good qualifier to pitch subject to?
Yeah, I mean, you want to pull the mortgage data. I would say 99% of the time the solar is not paid off, right? Again, another pro tip I'm going to give you guys, go back, Google Earth. It'll tell you, go look at the images of what year it was taken. You can see on the top of the roof when they put the solar panels in, and you can kind of get a good gauge of where they're at in that loan, because that loan amortizes as well. Go pull up the property data. You're going to see what they owe on the property. It's all public information, and you're going to be able to go ahead and kind of do your math equation to see if they have no equity and see if it's a potential deal.
Thank you. That answers my question.
All right. Let's go to owner finance. Is this dead? I'm pointing it the wrong way. There we go. All right, owner finance. 5 elements to an owner finance deal. Owner finance. Well, let's start with reading what owner finance is. Also known as seller financing is when you, the seller, because again, we're talking to the seller here, act as the bank and allow the buyer to make monthly payments to you over time, rather than paying everything up front through a traditional loan. The buyer gets the keys, you keep the note, and collect payments with interest just like a lender would. It is a powerful way to transition from being a landlord to becoming the bank. You guys can use my lines. It's okay. I didn't invent. I think I've heard this one. I'm going to transition you from being a landlord to the bank. That's another one I use. You guys can write this down when you're pitching this to sellers. What interests you more, a pile of money or a river of money? Which one's better? I guarantee they're going to say a river. Most people that do these properties, again, are people that have paid off a property, are obviously up in age because most people have 30-year mortgages. Average, 20, back in the day, people were buying houses in their early 20s, believe it or not. And so people in their 50s, 60s, 70s, baby boomer age as well, they're liquidating whole portfolios. They don't want to get hit with taxes. We're going to get into that. Instead of dealing with tenants, toilets, or turnovers, you earn passive monthly income secured by real estate with none of the headaches of ownership. How does it work? 1, you and the buyer agree on a sales price. 2, the buyer gives you a down payment. You both agree on loan terms. A promissory note and a deed of trust are signed and recorded. 5, the buyer makes monthly payments to you until the loan is paid off or refinanced. Bold letters, you stay protected with legal documentation and the ability to foreclose if they default, just like a traditional lender. Again, I'm gonna pound this into you guys, the importance of working with a lawyer when you're doing these things. By me working with Austin and his group over there at Thompson Law Group, it has gotten me deals by just saying I work with them, because the seller was also working with them. I know that law group. Also did a deal with a guy he was in the Navy with. I bought his house. They call him up. Hey, do you know this guy? Yeah, I know him. He's a real guy. He's a real buyer, right? Because you guys, again, that's why these relationships will really get you business. It makes people feel comfortable when you're doing the structure. Anybody that has been in real estate that long enough to pay off a property, and you go in there and just say, hey, yeah, give me your property, and we're going to do this, we're going to do that. You need to be able to articulate, explain, and educate them the process. Hey, you're going to be protected by a first lien position, a deed of trust, and a promissory note. In the event I get abducted by aliens, you get to take the property back. You do not got to go through the foreclosure process, right? But you have to be able to understand what a deed of trust is and a promissory note. If you don't understand those two things, why would someone want to sell you their property owner finance? You don't even know they're going to be like, you don't even know what you're talking about. You say those two things, you get your foot in the door. That gets their ears turned up. Then you can use these lines, like we're going to transition you from being a landlord to the bank. You're going to be secured by a first deed of trust and a promissory note. They want to know, how are they protected by doing this deal with you? Benefits of owner financing for you, the seller. Monthly cash flows without the hassle. You receive reliable payments each month without being responsible for repairs or tenant issues. Higher sales price. You can often sell for more than market value because what you're offering flexible terms. Tax advantages. You avoid one big capital gains tax hit by spreading the profit over time, increasing your after-tax returns. This is one that is going to get their ears to stand up. When you tell them how they can beat Uncle Sam, because Uncle Sam never loses, right? They're telling me I can beat the tax man somehow, some way, get some type of competitive advantage over them. They're going to be like this. And again, these are things to write down. Adjusted basis, depreciation, those two words. Look them up. You have to be able to explain to a landlord what adjusted basis is and what depreciation. And understand why the government gives tax benefits for us to be private landlords. Understand we had a public housing crisis decades ago. Government said you become a private landlord, we're going to give you a tax benefit. But when you sell that property, we need that tax benefit back. So anyone that has sold a property that they have depreciated, there's a good term called recapture. I don't know the technical term, but I think recapture, they call it something different in the tax code now. But recapture is something you can Google. They got to pay that back. So a lot of landlords don't know that. People that aren't real savvy, they just bought properties way back when, they just paid them all off. They need to talk to a CPA. You can kind of give them this introductory lesson on the tax implications of selling a property versus doing it owner finance. Again, always tell them to consult with a CPA. Don't tell them to rely on your guidance, right? Because you don't know what tax bracket they're in. Quick and flexible closings, no banks, no appraisals, no delays. You and the buyer set terms and a timeline. Stay in control. You choose the interest rate, down payment, and length of the agreement. No more landlord duties. You're just going to get mailbox money. A check hits your bank every month. This is my favorite structure because it gives us as investors the most maneuverability to structure a deal that's favorable for us. 5 elements we have to talk about. I don't want to get to the contract yet because it gives away the answers. What are the 5 elements? They were on the last slide, so that's why time. So time is what? Amortization period. And write down amortization if you guys don't know what an amortized loan is. That's important. Amortized. So the length of the loan, that's number 1. Interest rate. Balloon. Boom. No balloon. No balloon. That's not part of it yet. That's a trigger word in this thing. Down payment, purchase price, and monthly payment. So purchase price, down payment, interest rate, term. Now I messed up. Let's go back. Monthly payment. Risk and considerations. You don't get all the money up front, Mr. Seller. I'm sorry. You can't go buy that new Ferrari. You still are tied to the property until it's paid off. You remain connected to the deal until the loan is satisfied, but without the maintenance responsibilities. You must vet the buyer. Since you're financing them, choose a reliable buyer is key. We help with the due diligence to help the risk. And 99.9999% of the time, I'm the end buyer. I'm not in the business, and I'm not condemning it. I'm not in the business of assigning owner finance deals and subject to, right? Because if I assign that deal to Joe Blow over here and he doesn't perform, the seller's not going to be mad at Joe Blow. He's mad at me. He made the deal with me. And my name, my company, my reputation, my integrity is now on the line. So for me, my business practice, I don't assign these. I keep them because I'm responsible for making the payment in the event anything happens. We know that plenty of tenants don't pay their rents. We got knowing the buyer. He said, what is the key to assigning them? I have assigned them before, but it has to be someone, like obviously, like if it was Carrie, I would assign a Carrie the property because I know Carrie's financially solvent. She's responsible. She's an investor. This isn't her first rodeo. She owns tons of rental properties. I trust that she knows what she's doing, right? You have to really have some type of deep relationship and know that somebody's financial situation and their ability to service the debt. So we talked about the 5 elements. So we're going to talk about a real deal that I did. Well, I said, so why consider it? It turns your property into a true investment, steady income, interest earned, and less stress. It is one of the smartest exit strategies available, especially if you don't need all the money today. You're not just selling a house, you're building wealth, like the bank. Real world example, boom. So this is a real property, 2032 Iowa Street in Chesapeake. And again, I have to Google this to remember the specs on this house. This is a real property that I purchased. You can see what date, back in September. So this property it was a 3-bedroom, 2-bath, it's not listed correctly, about 1,500 square feet. So market rent, if you guys want to write market rent, renovated was about 2,200, I think, on this area of Chesapeake. The property needed about $35,000 to be flipped. The house was it was a little weird. I think sometimes what I've learned over my flipping career, because I flip as my primary business now, that houses don't all renovate equally, meaning that no matter how much money you put into them, you can't make them show good. When they walk in, there's something funky, and this house had a real funky way of walking through the living room to the dining room to the bedrooms. It just was weird. And so I was concerned about the ability to renovate it and to really achieve that max value that I wanted to get out of it. The sellers wanted about 275 for the property. It was ARV is 300,000. It doesn't take a genius to know we're way off. We're mountains off. And so I'm like, what do I do here? You know what I mean? The house is vacant. They're older. They're like, hey, look, we're tired of being landlords. We bought a bunch of properties way back when he was working. Husband's retired. Wife was the property manager. She's tired of property managing. What do we do? And I'm like, I can't get nowhere near that. So I'm like, look, I'll give you 205 cash. I think I offered them. They laughed at me. That happens, right? We all get laughed at, right? I was like, look, I only can pay 205 cash. I know it's not what you hear, but they're just like, nah, we'll just keep it, right? People that they got it paid off, it's free and clear. What's in it for them, right? So I always go super like that. You're taking the wind out because I already setting them up for this. Because again, this is the typical client that is going to do these deals. Older landlords that own the property free and clear. If they don't own the property free and clear, this strategy goes out the window, guys. Just clarification. You can look it up on the MLS or look up the tax records if they own the property free and clear. Usually look at the transfer of ownership. Boom. So with this deal, I said, okay, how much are you getting in rent? We're getting $1,200. Let's reverse engineer that. What are they netting? If they're getting $1,200 in rent, what are they netting? About 50%. Break that down, brother. Can someone give this gentleman a mic right here? Hold on, they're going to get you a mic. They're going to get you a mic. I'm trying to follow protocol.
They've got repairs every time somebody moves out.
Okay.
They've got time that the property's vacant,
So
that they're losing rent.
2 constants every month that they have to pay.
They got taxes and insurance.
Right?
Right.
So perfect. That's all. Thank you for that. So what I do is now when you're in these meetings and you're pitching them, right? We're reverse engineering. You're getting $1,200. Great, awesome. And what are you paying in taxes? You're paying what? Okay, you're about paying like $200 a month, and then insurance about $150. So you're netting what? $800 to $900. Yeah. And you got repairs, right? Yeah. I'm bringing out all their pain points, right? They don't know it, but we're working through the deal. Okay, what if I netted you around $1,000? What if I put that? I'm going to give you a down payment. So I said, look, I'll give you $250 for the property, right? I'm going to give you $20,000 down, and you make. I'm making all this stuff up, right? Now there's 5 elements we got to hit: price, down payment, time, interest rate, monthly payment, right? If I spit out that whole offer initially, you're going to get pushback. It's throwing them a brick. I use the analogy or illustration of a brick because you cannot mold that brick. If I said, hey, sir, I'm going to give you $250, $20,000 down, $1,000 a month, 3% interest rate, 30 years, boom. You're like, whoa, I'm not doing that. I'll be dead in 30 years. People say it to you all the time. It's just reality. People, when they're 70, 80 years old, start thinking about mortality, and it's something that you got to have these conversations. I throw them Play-Doh. Don't throw them a brick. So monthly payment is the first thing I start with. That's me. Again, everyone has different metrics, what's important to them, right? I like monthly payment because I want to make cash on cash return. I want cash flow. I'm buying an income stream, right? So that determines your rate. I get them, because if you say, hey, 3%, they're going to be like, they're going to start doing that to you. They're going to laugh at you. 4%, they're going to laugh. But I'm putting them into a hole. I'm getting them to agree to the monthly payment, and then I'm going to get them to agree to the purchase price. That determines the rate, right? So we're using a little bit of jiu-jitsu to come up with these deals. So I said, $1,000, that works great, awesome. I said, look, I pay you about $250. I think we could do with that, $250, great. Look, I need 30 years. Whoa, wait a minute. 30 years. I said, look, man, I got to be able to cash flow. Like you said, you're only renting it out for $1,200 in the condition that it's in. I need a little bit of margin to put money in the property, raise the value, raise the rent. I need 30 years to make the debt service manageable. Well, I'm not going to be here in 30 years, Junior. I said, okay. Yeah, I got gray hair. People call me Junior. I love it. It's going to happen for a while. So what you do then, right, is you have to do that good thing as a balloon. Now, this is going to be hard, right, and you're beginning to know this, but this is why the math of the real estate is the most important thing. You're going to pull out an amortization calculator. So if you guys have a mortgage calculator, right, I want you guys to put this in your mortgage calculators, right, because we're going to figure out what interest rate I paid for this? 'Cause I don't even remember now. 250? Well, let me see. I don't. Actually, I'm gonna give you the terms are on the next page, so I might be lying on how much I paid for this house. Just guessing. 6.63 at what payment is that a month? $1,000 a month. 250. $20,000 down. $1,000 a month was what interest rate? So if you put it in your calculator, this is what I do with them with this in the appointment, right? You can play with these numbers, and I do this live on the appointment. So let me pull out my mortgage calculator. So purchase price $250, and then down payment is $20,000. 3.24. Perfect. So when you play with these terms, everything's fictional. You're creating these terms. This is the actual terms I did. So 230, I had 5. They beat me. Anything 5% or above, I lost. They won the deal. So I tried to get everything below 5%. And so my payment was $1,234.69, 30-year. They did straight AM. I got lucky on this one. So this is why, again, there's 5 elements. I threw them Play-Doh. They came back. I'm able to mold that. I started with the 3% rate. That's what I remember now. Now, I can't lie to you. This is what I paid. There's $1,000, I think, was around the 3% rate. They said, look, I'll just put the money in the stock market. I'll get way more than that. I can't argue that, right? I said, all right, I'll give you 5%, but they kept this long term. They're like, look, we're going to pass this income stream down to our kids instead of the property because we feel that the property will cause more rift between our children than the income stream. That was their thought process, and it was a 30-year term. So now I just acquired this property for $20,000. Again, so less than 10% down, no income check, no credit check, and we closed, I don't know, I can go back, in 27 days. So a 27-day close. And so I need to redo this contract. Austin, remind me. This is terrible. See, I'm marking it up. And so when we do that, right, we formulate the deal that fits what I'm trying to do. We talked about exit strategies. Now, I'm not going to go into them because some of them aren't my techniques, but one is a slow flip. Got to go to Scott Jelinek. He'll tell you all about it. That's his game. That's one exit strategy. You got it as a long-term rental, right, which is what most people do. Rent it out long-term, traditionally. You have mid-term, which I don't do. And then you got Airbnb, short-term, which I did. I no longer do. I don't like the model. But if some people love Airbnbs.
Real quick, just to define, midterm is anything 30 days plus, right? A midterm rental means 30 days plus. Short-term rental, you guys probably know, Airbnb is really any length of time, a day or more. But just so everyone's clear, you got the long-term, which typically is 6 to 12 months at least, and then that rolls over. Midterm, 30 days more. Short-term, any other time underneath that.
Perfect. And so I want to show you guys this structure, again, how you are molding this deal to fit your needs and the seller's needs. Now, I always use owner finance. You always produce a cash offer. Most of the people that are in this space, you guys are going under the guise of a cash offer. You got to be prepared to produce a cash offer. You're disingenuous if not. Doesn't mean that we're not pulling these tools out, but that's why, again, I was able to gain market share when I entered into this space because I have 5 ways to give them an offer. I have 5 different offers. Cash, subject to, owner finance, novation, and a traditional listing. I built a real estate team day one when I started wholesaling, right? So I got 5 options. Again, if they don't have the property paid off, this isn't even an option. So very simple. It's paid off. I'm already in my mind. I'm going to an appointment, I'm meeting up with someone, they have it paid off, I'm having this structure ready to go. In my mind, I've got to know what the market rent is. I'm kind of going to know what my ARV is. I'm going to have some basic tenements of the structure in my mind. As you get more advanced, you don't need to write it down. I literally pull out a calculator and agree to them right on the spot because I'm just playing with numbers because I've done it a lot now, right? You're formulating these to fit what your objective is, whether it's cash on cash return. You guys are looking at cap rate. You can use this structure to buy anything. I use this structure to buy a hotel. I thought it would be a great idea, which, it's turned out to be a good idea, but it was a lot bigger reno than I thought. Rehabbing a commercial property is totally different than rehabbing a residential property, and I learned that lesson the hard way, right? With my own money, thank goodness, me and my partner. But you can literally, and the reason why I want to bring that deal up, that deal came across my table. No one was getting the cash offer. No one wanted to pay it. I went in there. I offered these people owner financing. I bought a hotel with $60,000 down. Thank you so much. I was dying. And again, you're working the numbers. It's hard when the asset was vacant, right? So it's harder to predict a commercial asset. And so again, it's so important to understand the math of real estate because you got to know where you're going. To structure a deal, you got to, how am I going to monetize? What is this property, what is this asset going to bring in from when it's renovated? You have to be able to predict and see the future. Before I go into how to flip, does anyone have any questions on using owner finance as a rental?
I just have a question on this particular deal. So since this was already a rental property, did you put any money into this to rehab it or?
I didn't. That's one of my secrets. So some properties like this are turnkey in a way. Turnkey, you guys have to define what that means for you guys. My definition of turnkey, foundation underneath is great. There's no foundation issues. My HVAC's good. My roof's good, and my windows are good. Other than that, the cosmetic stuff, obviously, you can't have dirt. It can't be dirty. But I'm more concerned about the structural integrity of the property if I'm going to let someone live there because that stuff costs lots of money to fix, and it inhibits someone's quality of life. You got a bad roof, it leaks, you're going to have problems as a landlord. Did I answer the question? But I do, again, I told you guys some strategies. Look at wraparound mortgages, look at slow flips, look at short-term rentals, mid-term rentals, long-term rentals, lease options. These are all different strategies. I don't use all of them, but I use half of them. Any more questions on how to use this as a rental? All right, so we're going to talk about how to use owner finance really quick as a flip. We're burning out of time here. So let's say this property was worth, let's say conceptually this property is worth $300,000. We're going to do the math now. How do you structure this as a flip, right? So when I walk into the property, $300,000, on my mind, I know I probably, right off the back of my head, before I see the property, I probably can pay $170 to $175 cash from my experience, right? You have an idea based on what you think the condition is, what you can pay cash. So take this property, $300,000. We're going to do some math, right? You're going to subtract 10% cost of sale. Now, some of you guys, maybe like me, have your own real estate agents that work for you. Your resale costs are lower. Again, do not try to discount a realtor's agent commission unless you're providing them extreme value. You're going to make somebody mad. Or you're going to work with someone that doesn't know what they're doing. If a real estate agent immediately just drops their commission, do not work with them. I'm telling you. That means they don't know what they're doing. They have no value of their profession. I'm just saying. I'm a retired real estate agent. I ain't been licensed in a decade, but just a little pro tip. And so we're going to structure this. $300,000 is our ARV. The property needs $40,000 in repairs. Does anybody want to tell me what they would pay for the property? Cash. $300,000 is our ARV. $40,000 is the rehab budget.
I'd say if you offered 176, I'd offer 177, right? Okay,
I love it. I love that. So is that your max allowable offer with your math?
We heard 180 back
180? 170 you got? Okay. And what, anybody else got different numbers? 175? Okay, so we're in that 170, 180 range. So it looks like it's the consensus, right? So when you have that in, you walk the property, you've determined it needs 40,000. Well, I'm negotiating with Scott. You don't mind if I use you, right, Scott? Scott's the seller. Same thing. Scott's got the property paid off. Wife's been property managing it. They're ready to RV and go to Florida. So I know that they want a cash price closer to 180. I want to be, let's say, closer to 160. Let's just say that's where I want to be. This is all hypothetical. I'm going to tell you guys how to structure this and the power of owner financing. You need to produce the cash offer. Hey, Scott, what you exchange in the convenience and speed of a cash offer, you're going to sacrifice a little bit of equity. I could do 160 cash, as is, where is, all closing costs, boom. Close in 2 weeks. Look, but if you're willing to hold the property for about 6 months, I can give you 175. I can put about $15,000 more in your pocket. Now, why do you guys think that is? I gave you guys the answers to this test, but I'm going to ask you guys this question. Why do you think we can pay $15,000 more? Why am I so willing to pay $15,000 more than just do 160? Who just said it? Points. So 2 points, that's $5,000, right? Or it's a little bit low. We got about 10 grand with points and closing costs. You're close to 10 grand, right? And then you got monthly payments. That debt service is going to be, that interest payment, 12 to 14% is going to be astronomical versus what I'm negotiating with Scott. When I do these short-term owner finance deals to flip the house, a lot of times I get 0% interest for the first 3 months. So I'm going to give you guys my secret hack on how I structure it. I'm going to give you 0 to 3 months, Scott, 0% interest. After that, I'm going to give you 7%. How does that sound? Boom. Or you can just do a straight 5, whatever you want. But I use that because now it incentivizes me to get my crew's butt up off the ground, flip the house, get it sold, because then I don't got no interest on it. It increases my margin. If it spills over a month, then I got a little of a bit of a payment. But again, that gives me upside and it shows the seller, right? Sellers usually go for this. Why? Because now they see, okay, in that first 90-day range is when I really get incentivized to work hard. They know that, hey, I'm trying to hit that. They want their money. And I'm also paying more, right? Hey, look, I'm happy to give you the 160, Scott. I want Scott to take the 162. I'll be okay with it. I'll be happy if he takes the 160 offer. But again, you have to give them choices, right? I learned this in sales. It's called an alternate advance when I sold cars, right? Because people would come on the lot, hey, I'm here for the black Honda. We don't have a black Honda on the lot, right? So I said, look, I got a blue one or a red one. Which one do you want to test drive, right? If they have one choice, one option, it's a yes or no question. Now I'm giving them more than one choice. Hey, Scott, 160 cash. I could do 175 if you hold it for 6 months. Again, we go back to the balloon payment. You go back to the deed of trust. You go back to the promissory note. All the elements legally to protect Scott are the same. So you need to write those down, study them, and again, be able to articulate these things in your own words because it's just an education process. You're taking sellers through a simple education process with creative financing of how they're protected, how are they going to get their money back, what happens when you sell the property. You have to be able to answer all these things up front. And I like to over-explain up front, right? Because if I over-explain, I tell Scott, hey, this is what's going to happen. I'm going to renovate it. Once we sell the property, they're going to reach out to you. Thompson Law Group, they're going to do the closing. Hanger Law Group, they're going to do the closing. They're going to produce a payoff. When I go and the proceeds get wired in, you're the first one to get paid off. I can't transfer title without you getting paid off, Scott. And the lawyer, it has a fiduciary responsibility to you at the law group. They're going to make sure you're taken care of. Boom. That's their comfort. That's their security. If you can't explain to someone how they're protected and secured, they're not going to do business with you. They're just not. They're going to shut down the conversation. So we put, again, the difference between 160 and 175 to me is nominal. I don't have to go get a hard money loan. I can really maneuver very quickly and just flip out of this property and make a healthy profit. And you can do this at any point of your negotiation. A lot of people think, okay, property's paid off, let me just keep it. A lot of people don't want to keep the property open. Figure out a way to make it a win-win. Owner finance, short term, I'm turning Scott into my private money lender. Because if I go to these real private money lenders, I'm paying a whole heck of a lot more. Again, they provide a very valuable service, but you 9 times out of 10 can get cheaper terms and flip the property with Scott. What is the challenge though when you're doing owner finance and subject to flip? Anybody know what's the big challenge if you're trying to flip these type of structures with creative financing? You know, there's no mic over here. Oh. Yeah, the challenge. The challenge is when you get a hard money loan, you're going to get monies for renovations. Sometimes. They fund the rehab, right? So you're only bringing in partial. You're getting a certain loan to value or loan to cost. However that lender structures the deal, you're going to get a lot of that rehab money when you're fix and flipping, right? When you're doing owner finance and subject to, you have to have the certain liquidity because when you're doing owner finance or subject to flip, you have to put cash into the deal and renovations. So if I'm buying Scott's house, I said, hey, I'm paying you $175 owner finance. I got to have money for a down payment. I got to have money for closing costs, and I got to have the money for the renovations. My business model, again, everyone has their own way of doing business. There's no right or wrong way. They all work. There's a million ways to make $1 million in real estate, right? What I like to do is I don't like to borrow money to do rehabs. The rehabs. I've never, ever in my career, I've ever borrowed one penny to do a rehab. That's just me. People have different strategies. I know from 08, 09, I can only get in so much trouble if I put my own cash for the rehab. I can only get in so much hot water. So that's just my business model. Again, you can talk to people that have borrowed it and maybe it has made sense for them. That's how you structure the owner finance to flip. What questions do you guys have structuring an owner finance deal to flip it? I got 10 minutes, I think, to knock out the last slide. We got one in the back. Hold on, he's going to come bring you the mic. I don't want to get booed off stage so quickly.
What was your monthly payment on the deal for them?
Well, that one was a long term. It was hypothetical. I was talking
right.
I told you, I've done this structure recently. I only came up with this last year, but 0 to 3 months, I try to go 0%. It's interest only. Everyone understand the difference between interest only and amortization. Amortization means the loan's being paid down. Mostly interest in the beginning, a little bit of principal is getting paid down. Interest only, you're not paying down any of the principal balance. So if I borrow $175,000, I'm not paying any of that down. The seller's just getting straight interest on top of the $175,000.
But they're still paying taxes and interest.
No, we transfer title on all these events, all these structures we talked about. There's a closing that takes place with the title company. Taxes and insurance are responsible of me because I'm transferring title into my name. Any questions on that? Any more questions? We're going to skip to the next slide. Oh.
What do you advise us to do when you're doing properties like that, keeping them in your name versus putting them into an entity?
Well, so I'll re-clarify that. I take title. I've never took title in my personal name to any property in my life, believe it or not. My primary residence is owned by a corporation, and my other company rents that property, owned by all that stuff. So you talk to someone about lawyers, is great to talk to about foreign trust, land trusts, LLCs, how you hold. I would recommend from my personal experience and from the advisement I've got that you have a certain level of assets you keep in one entity because you're exposed past $1 million or you have some type of threshold and you gauge your risk when you're holding property for exposure. If I buy a big asset, it has its own LLC because like if you go buy a hotel, you don't want to mix that in an LLC that owns 15 houses because it's just different legal implications, different tax implications. Again, but I would consult CPA and attorney to the best strategy to use for different types of assets. Last but not least, guys, I'm sorry, I'm making people fall asleep now. I need some light. We need some music in here, some Drake or something. All right, novation. Who's done a novation in here? Hands up. 1, 2. Hey, we only got 2 people. Wow, so this might be a good topic then. Maybe this will wake everyone back up. Can I get one clap from everybody? Wake everyone. Wow. Okay, all right. Whoever was sleeping there, awake now. All right. What's a novation agreement? Novation is a creative real estate solution that lets you partner with an investor or buyer to improve and sell your property at full market value without doing the work yourself. Instead of selling your home as is for a discounted cash offer, a novation agreement is agreed upon amount once the property sells. You're not assigning your contract, you're replacing yourself with a new buyer at closing. This is what novation literally means, replacement. How does it work in a novation agreement? 1, you and the buyer agree on a guaranteed price that you'll receive no matter what. The buyer updates the home at their expense, not yours. 3, they market the improved home on the MLS and handle showings, negotiations, and offers. 4. At closing, you get your agreed amount and the buyer keeps the profit above that. You are not responsible for the repairs. You don't pay commissions. You don't lift a finger, but still get a better payday than a lowball cash offer. I know there's questions already. You want to stop now or do you want me to keep going? Okay, love it. All right. Benefits of a novation for you, the seller. You get closer to full market value. You are not stuck with the low investor offer. We invest in making the home shine and split the upside. Avoid agent commissions. Unlike a traditional sale, you won't pay realtor fees. That saves you thousands at closing. Flexible timeline. Need to stay in the property during the process? We can work with that. You are not rushed out. Now, I don't fully agree with this, even though I created this. But again, you can't tell someone, get out. You know what I mean? So I do not prefer to do work on a property that someone's living in. You guys inherently know the challenge logistically and financially with that. No repairs or cost to you. We pay for all renovations, materials, contractors, everything. You don't spend a dime. Stress-free process. We handle the marketing, repairs, buyers, and paperwork. You just show up to the closing. You guys want me to keep going? Okay. Risk and considerations. You got to wait until the property sells. You don't get paid until the updated home sells. If you're in an urgent need of cash, this might not be ideal. You're still on title until closing. You retain ownership and responsibility until the end through. You're not doing the work. You are still the seller. Requires trust and agreement. Because someone else is making decisions and investing money into your home, clear terms and trust matter. This is why we use legal documents and full transparency every step of the way. Limited fit. This is a takeaway in sales, guys. You guys know what the takeaway is. Novation works best for homes that need work. Sellers who want more than a low ball offer and are open to partnering on the sale. If you want fast cash and no wait, this might not be the one. Pain points, right? Hey, if you want fast cash, this isn't for you, right? So let's go back to slide 1. Anyone have questions yet? I'm going to pitch. I'm going to give you an example. We're going to use the same example as the house before. 3-bedroom, 2-bath, 1,500 square feet in Chesapeake. ARV's 300,000. Boom. All right? You're using a novation. What type of property are we looking for? You're looking that most of the major systems are good. This is my model. I've done tons of these. The very first one I did, again, sometimes it's better to be lucky and good. I didn't even see the property. It is the craziest Jason Bourne story ever. It was a CIA agent's house in Ashburn, Virginia. It was a $1.7 million home. I locked it up sight unseen. I did about $15,000 of work, and we sold it for a healthy profit. And it was crazy because right before closing, the buyer tried to back out because the lady that was selling the property, her husband got murdered in the property, and they were in the CIA, and it was like this whole conspiracy theory thing. It was crazy. But that was the first one. So what we did, you agree on the type of property is when it needs minimal repairs, right? So for a novation agreement, when you're walking in a house, if the roof's bad, HVAC, windows, that's not really a novation candidate. You don't want to sink, and again, I've learned this from losing money. $10,000 to $15,000 usually is my threshold of how much money I'm going to risk. Why is the risk so inherent with a novation? You don't have title. So I don't technically control the property. You're going to get what's called an attorney-in-fact document signed. Again, do not chat GPT this document. Please. I'm telling you, what you try to skip in paying these guys, you're going to lose in the long end. I promise you. You're going to get an attorney-in-fact document that's going to allow you to execute the MLS agreements. It's going to allow you to execute PICRAs, addendums, everything to get the deal closed, right? So you can only put about $10,000 or $15,000. It has to be very light renovations. Usually, you want the property vacant. Nobody wants to paint, do flooring and stuff in a house, and someone's living there. They're going to destroy it. It deteriorates the value. What we're trying to accomplish with the novation, and again, the easiest way to understand this is an illegal thing called a net listing. This is like a net listing, except you're investing money into it. Net listings, you're not. Net listings are illegal in the state of Virginia. They are illegal in some other states in the United States. But it's the easiest way to understand it. You're agreeing to a price to them. So let's say Mr. Scott wanted more money than my 170 cash offer. We all talked about what we were paying. Again, 3-bedroom, 2-bath, 1,500 square feet in Chesapeake, worth $300,000. That's our example, right? Let's just say it needs flooring, it needs paint, and let's say we need a hot water heater. So about 10 grand, right? It's a 1,500 square foot house, right? Say we're spending about 10 grand. So I go to Scott. Scott wants more than 170. As a cash offer, you guys know we're right there, right? Let's just say 180 and Scott's like, no, I got to be over 200,000. And you just know as a cash purchase, right? Your lender's not going to approve that. There's no deal here. It's a bad use of your capital. Well, I said, well, what if I were able, look, cash, for a cash offer, the max I can go is 185. And Scott's like, you're hitting a wall. Most people, when you guys go on these appointments, what do you do? You just walk away. Thank you. I'll call you later. Just walk out, right? No, you got to have this tool in your tool belt. Hey, Scott, what if I had a different structure that put more money in your pocket? Are you interested in hearing about that? Who's going to say no about making more money, right? Hey, look, we're going to agree on a net price. Because at the end of the day, and anyone in real estate, write this line down. At the end of the day, the most important thing to you is what you net or what you walk away with. The most important thing to you, Scott, is at the end of the day is what you net and what you walk away with. If you're an agent, you're an investor, a wholesaler, whatever you are, that line is going to save you and make you deals and make you money. That's what you're trying to fixate on, the net. What we're going to agree to, Scott, do is we're going to agree on a price today. If we do this agreement called a novation, we're going to agree on a net price. You're going to walk away with $200,000. What I'm going to come do is I'm going to come alongside you. I'm going to come do some repairs. We know that your flooring right here, this is not going to pass financing. You got some drywall damage, you got some holes in the wall, the tenants really mess up the property. We're going to get this thing back up to snuff. The hot water heater's not working, you told me. We're going to get all that changed out so we can put the property on the market. Because ultimately, Scott, the person that's going to pay the highest for your property is an end buyer. Someone that's going to end up enjoying the property and living in here. It's a great neighborhood, isn't it, Scott? It's beautiful. Right? And so you're talking to them through this, and you're going to pitch this. This is just like listing your house, except there's no headaches. We agree on a net price today. In about 90 to 120 days, you come up to a closing table. I deliver that result on a silver platter. It's like listing your house, but on steroids, Scott. Why do people do no? Why would seller enter these agreements? Help me out, guys. Don't have to pay an agent. No repairs. Lack of cash. Great answers, guys. All valid points, pain points, right? And so how do you do the math? How are we doing the math to structure a novation to see, hey, Scott, is this going to be a good deal for him? And am I going to make money? This is very difficult. This is a very difficult thing. And again, I do not recommend doing this unless you've done, even if as a real estate agent, 5 to 10 transactions. You have to know how to properly evaluate and appraise a property that's not fully flipped. And that is the hardest thing to do in our space, right? So, because I'm only doing flooring, paint, and a water heater. So I got to look at the kitchen that Scott put in there, the bathroom that's from 2016, the roof that's from 2017, the decks from 2007. He replaced the appliances a couple years apart. Everything's chopped up, right? You got to be able to pull comps, have the experience and knowledge to understand, okay, after I put carpet paint, let's say that property is going to sell for $250, right? Or excuse me, yeah, $250, because our ARV is $300. We're only doing flooring, paint, and putting a hot water heater. We're not doing kitchen, we're not doing bathrooms, we're not doing all new fixtures. We're not forcing appreciation up to that $300,000. So how I do my math is I'm going to subtract 7% cost of sale from what I think I can list it for with my agent, which is $250. 7% for me, because again, I give my agents a lot of business. They're going to list this property for 1%. I'm going to offer 3% to the buy side and another 3% in CCA. Again, this is my practice of business, may not be yours, but this is what I've always done. I always budget paying 3% CCA. Closing cost assistance. Sorry, guys. Closing cost assistance. Because I saw people when that interest rate environment flipped, took baths. Because they're buying properties. I'm going to sell at top dollar, no CCA, bada bing, bada boom. And boom. What happened? Rates flipped. People needed closing cost assistance. Debt to income ratio levels changed. So again, I've always budgeted. And again, you make an extra 3% of the sales price if you don't have to pay CCA. So it's always a nugget. And if I lose the deal, I lose the deal, right? That's sometimes the best deals that you do are the ones that you don't, right? And so I'm structuring this 250 minus 7%. It's about 15 grand. Quick math, right? So 250 minus 15 grand. That brings me down to what? You guys can write this down. So 250 minus 7% cost of sale. Again, you have to get your cost of sale down. You have to have a relationship with an agent. Can't just go to an agent and say, hey, list my house for 1%. It's rude. All right, I'm just being real with you. And if guys, remember, if they agree right away, yeah, I'll do it. Whoa, wait a minute. That means they're not busy enough or not experienced enough to have value in their profession, right? Because that good agent they're going to save me 3% by getting me no CCA. So 250 minus 15,000, that brings me down to 235, right? I put 10 grand in the property. So that brings me down to 225. And when you do a novation, I got to pay the seller's closing costs. So budget just put 3,000 in there and another 2,000 in picker repairs. So 250 minus 15,000, that's a 7% cost of sale. Minus 10,000, that's repairs. That brings you down to 225. Minus another 5,000, that's closing cost, seller's closing cost, and picker repairs. That brings you down to 220. Me and Scott are under contract with this novation agreement as a $200,000 net price to him. I make 20,000 bucks. Very simple math. I didn't have to close on it. I didn't take title. I risked 10,000 and I made 20. You're gonna get the 10,000 back on the HUD plus your $20,000 profit. It's a very simple process. I know it sounds very convoluted, but anybody who's flipped, it'd be very easy for you to do novations because we're appraising property. So we're getting really short on time. I can't go as deep into this, unfortunately, as I want. But I want to open up questions to a novation. I think it's a very powerful tool, or anything that I've talked about up here. Give 5 or 10 minutes, whatever you guys want, and free questions. Ask me anything, except my blood type.
Yep. We got time for a couple questions, and then obviously, if Gio's around and available to stay past. Yeah, we got a question in the back.
Can you do novation if they still have a mortgage?
Yeah, absolutely, right? So we talked about that they have to encumber the debt service while this process is going. Now, if someone's in financial trouble, you may struggle with that, and you can do deals like I'm doing one now where I'm encumbering the mortgage. It is risky. Again, it added in to the overall risk profile, and I invested $20,000 into this property. So I went outside my guidelines, but the upside's there. And again, now my novation agreements, I have ironclad legal documents. I've spent a lot of money on them, so I feel comfortable. But you can structure it 2 different ways. Sometimes what I do is say, look, Scott, I'll give you $200,000, you take care of the mortgage, or I'll give you $190 and I'll pay the mortgage. If the mortgage is $1,200, I'm going to hold the property for 3 months. I picked up extra $5,000 almost, right? Everything in life's a negotiation. So you got to run your math and always use it as a pain point. Because sometimes people will walk away from the novation deal because they don't have the money to carry a vacant house and carry what they're carrying now. But you can't get them to a cash price that makes sense, right? Most beginning wholesalers, they just lock it up or whatever. They think that they can just throw something to a wall and it'll stick, right? So instead of doing that, you're working this math. And if you have the financial ability to pay the mortgage, you probably get the property about $10,000 cheaper.
All right, we have time for one more question before we officially wrap. All right, we got a question here in front.
Yes, sir.
Thanks for coming out here tonight, guys. My name is Don Roby. I'm a general contractor that specializes in PICRAs and remodels.
Love it.
D-Port license. This is a little bit of question, a little bit away from this. Out of the last couple of years, out of the books that you guys read, what's the most influential book that you read that changed your mind thought in your business process, and why? And that's for both of you.
Mine's a controversial answer. You want to go first? Go for it. Oh man, this might be controversial for you guys, but he's the Michael Jordan of our profession. But The Art of the Deal by Donald Trump. I'll get into it. Contrary to what most people believe, Donald Trump started off with very little money relative to what he has today. He started off with very little credentials. They owned Section 8 housing. They weren't developers, right? Anybody in here? None of us in here, I think, are massive. None of us are the Breedens or, the W.M. Jordans of the world, right? They went from Section 8 housing to developing Manhattan. And basically what I learned from that book is just like there's no limitations on how big a deal you can do. The limitations are only placed on ourselves and your ability to construct the deal financially in your head, to work the math, and then to convince the city that you're the right person to take this down. It was his ambition and his big dreaming that got him, those properties that made him into the man he is as far as his wealth today. So that book taught a lot about how he leveraged relationships, the way he went about things, structuring these deals. Again, also how he was getting ready to go belly up and he went and literally said to the bank, take the properties. Good luck finding someone to do this construction. And he literally said, I'll walk away right now. But if you guys want me to stay in the deal and want me to finish it, I need you to change my debt service. And he went and renegotiated hundreds of $1 millions worth of debt from an international bank. And that's how he became wealthy. A lot of people don't know that. But again, for our purposes, it is a very powerful lesson in that book of knowing math, knowing when you have leverage, and again, dreaming very big.
Sure. Yeah, I'll very brief. There is a book out of the Harvard negotiation program called Getting to Yes by Getting to Yes by Uri and Fisher. And that's probably one of, if not the most powerful negotiation books I've ever read. And it's used by attorneys, mediators, and everyone negotiating deals that I know of. And that is really, very briefly, it is intended to teach you how to get to the interest of the person that you're negotiating with. Not their position. Their position is, I want $200,000 for this house. That's a position. What's the interest? They say, you know what? I want to feel like I'm valued in this real estate deal for where I got into it. What's the thing that's motivating them? That's the underlying interest. It's not what the position is. And Uri and Fisher do a phenomenal job. It's a very short book, but it's incredibly powerful. Teaches you how to get below the line to the interest of the party when you're negotiating, because that's when you unlock the most creative deals and solutions to whatever you're negotiating. So that's my brief answer on that.
I love that book.
Yeah. Hey, let's hear it for Giovanni. Woo! That's a ton of great information.
What a great question. Thank you, Gio.
If you guys want to get a hold of me, it's Gio_Paradis or Giovanni Paradis on Facebook. It's my real name, not my stage name, God-given name. I'm very accessible. I've done deals with over a dozen people in this room. I've made money with. I don't sell any courses. I have nothing to sell you guys. So if you reach out to me, I'm not going to try to sell you nothing. Just here as a resource. Big shout out to the group at Trig. Again, we're better together. Collaboration over competition. Let's keep doing deals.
Thank you, Gio. Let's also